All right. Did I bring my surfboard? Todd, where? Back to New York or San Diego? Absolutely, in San Diego. Yeah, Heba did a great job. She really does a nice presentation. So, all right, let's roll. I have a lot of content for you, so let's get into it. I like to swing trade in the options market. I find that there are specific style of methodology of technical analysis that I like to employ that kind of gives me context of like where we like to trade in the options market. So let's do the warning. Don't blow this off. This is pretty important. This market is obviously trading is risky. You've got to be prepared to take the risk before you dive into any trade, and not just the risk in your overall account, but every single trade. Okay. The only way you can do that, again, is to have a plan and understand how much money you're going into, you're going to put on the line heading into every single trade. I've been trading my whole professional career. Like, I'm the first one to tell you that trading is like a boxing match. You're going to get knocked down on your butt several times. You got to get back up, keep fighting, and try to win the decision at the end of 12 rounds. Okay? Never go for the knockout punch. All right? Always protect yourself. Always be moving. This is not a get-rich-quick scheme. I'm not telling you that trading is super easy. It's only for those who are dedicated and who like to work at it, okay? I have way too much respect for this industry and for my profession to tell you, oh, yeah, it's easy. You can learn in a weekend with this indicator. It's not that way. You've got to commit to it, okay? So I'm going to show you some live trades. I have live trades on. I am losing money right now, so I tell you the way it is, okay? I keep it real. So I am a big fan and believer of the specific methodology within the technical analysis world of Elliott Wave and Fib. It is a pretty big task to introduce this to you in about 60 minutes. So just be content knowing you're going to be a little confused in the beginning. You might be interested, and that will begin your educational pursuit. Out of curiosity, who in here is using any kind of Elliott, any kind of Fibonacci analysis? Are you using it often? Do you think it's voodoo? Is it witchcraft? I know enough to be dangerous. Like, just kind of throw some things in there. I'll get nice rolling. There you go. Fibs, yes. Elliott, no. Okay, cool. Arthur, all right. Occasionally, Don, okay. Fibs, but struggle with Elliott. Bill, okay, cool. Use it all the time. Paul, awesome. Oh, Toby, my man, he goes, I've been using it for 618 days now. You stole my joke. Ugh, Virginia, what's up? I know your name. Jay, Tom, hey, what's up, JT? I know you. Oh, all my crew's in here. Okay, cool. All right, so listen, if you're new, it's going to be a little bit like drinking from a fire hose, but don't worry. The idea is to get you interested, get you a couple key concepts, and then your education begins. So what we're going to do here is we're going to look at the current market, and specifically we're going to break the market down into trends and corrections and identify them through the lens of Elliott and Fib. I'm going to show you how options trading, both directional and non-directional options trading, fits very well into the world of Elliott and Fib. We're going to learn how to spread the risk in option trading to strive for consistency while most importantly managing risk. We're going to be using Elliott and Fib to isolate the likely beginning and ending points of trends and corrections. And then around that, you're going to structure your options trade. I was listening to the presentation. I was listening to it earlier on what Dan was saying about how they're mostly focused on intraday trading futures. And I was just thinking, well, I'm a perfect opposite to that because I like to swing trade options. So hopefully we'll give you a different kind of perspective in that. So let's first talk about mindset, guys. And this is the most important component of any trading education is the mindset, okay? It's not the indicator. It's not the setup. Like, if it's just that easy, there'd be a lot more millionaires walking around. It's all between your ears, okay? So that's the most important trading weapon you got to work on is the brain. So let's kind of talk about the mindset required to trade successfully. Cavemen were terrible traders. So thousands of years ago, when a caveman went into an uncertain area, like going behind a couple trees or bushes or into a cave, he didn't know what was lurking behind there. And we humans, even when we're a caveman, have survival instincts built in that is just automatic. It's innate to help ensure their survival. And their emotions. these survival instincts were fear, adrenaline, and aggression to pump up the chest and to go and attack whatever might threaten our life. This caveman mechanism that automatically elicits emotion has not evolved, okay? When we face uncertainty in today's modern life, this caveman mechanism of triggering emotion takes over. So they did a study on this, and they actually imaged brains. Caltech neuroeconomists image brains while they're making uncertain business decisions like investing. And they found that our brains are in fact hardwired to make it more difficult to make decisions in the face of the uncertain or the unknown future. The less information the brain had, the more activity and irrational and erratic it became. So what happens is the rational, calm, non-emotional decision-making is usually done in the front part of the brain. But when it becomes uncertain, emotions kicked in, and it physically shifts to the back part of the brain, which is the limbic system. It goes from the neocortex to the back, and this is where your emotions are generated. So basically, as we are trying to predict the future, which is what trading is, you are going to elicit certain emotions that make your trading decisions based on greed and fear and some adrenaline. And obviously, those aren't the things or the stuff that good trades are made of. So you've got to train your brain, and you've got to learn to control that caveman tendency and trade with EQ, which is emotional intelligence. Successful people can do this. And there's a study that shows those who have developed their EQ, emotional intelligence, on average make about $28,000 a year more. So you can do this. You can boost your EQ by getting good at making decisions in the uncertain future. Learn that you have to embrace what you can't control. You can't know the future. Have a backup plan. Learn from your mistakes. Learn from your trading mistakes, but quickly move on. Don't dwell. These are some of the things that you can do to become a better trader. End of the day, guys, this is all trading is. Don't make it harder than it really is. It's 500 big sweaty gorillas in a trading pit, following the crowd, buying and selling based on herding mentality, interpreting future data coming in. It's really not more difficult than this. So trading is a grand but imperfect pursuit of tracking collective human psychology and herding mentality that drives market prices in a repeatable, fractal, and identifiable form. You have to make the best decisions in life, like trading, with less than perfect information. You have to use everything that's available to you right now, but put yourself in the best position. And when it doesn't work, you protect your risk. And when it does work, you maximize your reward. Hard work, confidence, fortitude are the keys to success. So what's the point of all this? It's all about having context and trading with a higher EQ. As I said, in my short, I guess I'm 38, I started trading when I was 18. I've been trading for 20 years. I took my first professional trading job at 22. So I guess I've been in this market now for 16 years out of college. And I've been through every indicator, every methodology. Like I've devoted my professional life to this. And I'm happy to say Elliott Wave is what I am able to come out with after that exhaustive research that allows me to have context, control that caveman tendency, read the tape, read the crowd, and basically monitor and control myself, okay? So there's a lot of objections to Elliott, and I understand why, okay? And we'll kind of talk about that a little bit more, but Adam Smith, the modern grandfather of economics, say people fear what they don't understand and hate what they can't conquer, okay? And this, I think, completely encapsulates the objections to Elliott. Don't take my word for it. Let's talk to a couple heavy hitters in the industry who've influenced me directly and indirectly. Drew Baptiste, a good friend of mine. He's the chief technical analyst at Morgan Stanley and JP Morgan investment banks, like not the brokerage, retail arm. He was the global head of technicals at the investment banks. Speaking of the wave principle, it's a simple rule-based methodology that allows you to dissect the mindset of the markets, the participants, that allows you to formulate attractive, positive risk-reward trading. It's a game plan. And this is Drew playing with my two boys, Jake and Brody. He doesn't look like an investment banker. He's awesome, though. He used to play in a reggae band. He's a total trip. Tudor Jones, I hope you know who that is. Paul Tudor's worth over $3 billion. He's donated $1 billion to charity. He's in the Market Wizards book, The Classic, saying a lot of his success is attributed to the Elliott Wave principle because it allows you to structure favorable risk-reward opportunities. you guys have ever seen this video, it's amazing. It's called Trader. He worked forever to get it off the internet, showing him positioning prior to the 1987 crash, where he was short with help of Elliott and overlaying the 1929 crash, doing an analog chart. And yeah, so he pretty much was short in the 87 crash, which ironically was exactly 30 years ago. Soros is in the New York Times saying the Elliott Wave principle, as interpreted by Bob Proctor, was one of the contributing factors to the 87 crash. So it's very timely in this presentation. Okay, so Elliott Wave, okay? A lot of confusion out there. A lot of people say it's too subjective to be useful. Well, damn. If there was a formula for trading and in life, because they're kind of the same thing, we're trying to make the best decision possible to set ourselves up for success around the corner. I think if there was a formula or magic bullet, I think it would have been invented by now. So it's a catalog of market patterns that gives you context. Fib is beautiful in helping you figure out where these different trends and corrections will start and stop. I already mentioned that, kind of jumped ahead of my own point, too subjective. Some of the classic objections, if you put 10 Elliott Wave analysts in the room, you get 10 interpretations. It's curve fitting, it's hindsight, too subjective to be of any use. So let's take a look at this. You guys ever done any basic studies of classic chart patterns? Triangle, head and shoulders, parallel channel, bull flag, rising wedge, broadening pattern, double bottom. Ready? Ready? Watch this trick. Ready? 1, 2, 3. Boom. Fourth wave triangle, wave 5 top, 5 wave impulse, zigzag, ending diagonal, expanding triangle, corrective flat. I'll do it again. Classic technicals, Elliott Wave. Elliott Wave gives you context as to where you are in these classic technical patterns, and that helps you formulate a game plan. So I love the haters, okay? And the funny thing is, if a hater has objections to Elliott Wave, then they have objections to the widely accepted traditional technical analysis patterns. And the very reason that Elliott Wave works, which is tracking the collective herding mentality that drives market prices, people make buying and selling decisions emotionally. And that's what drives market prices. I don't care if you're talking discretionary trading or algos, they have those human tendencies programmed in. The very reason people like to object to Elliott is because it is subjective, and they're making an emotional decision or an emotional analysis based on what they don't understand. That's exactly what Elliott Wave is designed to monitor, is that emotional decision-making process that drives market prices. So for the very reason that people object to it is the very reason that it works. Or they're too damn lazy to put the work in. Okay, so let's go here. So Charles Dow, okay, this is the grandfather of technical analysis. Along with Dow theory, which told you that transports and industrials have to confirm each other, there was another part of Dow theory, which is that the market trend will unfold in 3 different phases: phase 1, phase 2, and phase 3. Accumulation, widespread participation, and distribution. Elliott picked up Dow's work and went to the next level and gave us first phase, which is accumulation, pull back in wave 2, this is your first corrective wave, big breakout wave 3, pull back in 4, and then a final 5th wave. So the 5-wave Elliott trend is really based in Charles Dow's classic theory of technical analysis, okay? Where are we right now? Okay, this is the Russell 2000. I think we're in the middle, where we are at the latter stages of your 5th wave, which is called distribution. People who are buying back here in accumulation and widespread participation, which is waves 1 and 3, are going to start offloading into resistance. I have 2 zones of resistance in the rut: 1512, 1617, 2015, 2169. I don't know which one's going to hold the top, but I'm relatively certain you will get a response, a sizable response from one of these 2 zones, okay? So that's where we are right now. So this is the 5-wave Elliott trend. Now there's 2 different ways that the market can trend, and I won't get too much into the weeds here, but if a market is trending, it's either doing what they call an impulse, which is your classic 5-wave move, 1, 2, 3, 4, 5, or it's doing a diagonal, which is still a 5-wave move, but you're getting overlap between waves 2 and 4. So it's kind of taking that ascending wedge or descending wedge kind of shape. This is called a diagonal, and this is called an impulse when you get the classic railroad track trend channel. Okay, the other one, I'm just watching your questions. And I want to engage. I love the comments you guys are putting up there. I got to keep pushing, but Elliott techs do not emphasize the go, no-go decisions on the right side of the chart. I don't think I'm following you, Bill, but I make go, no-go decisions all day long trading with Elliott. Maybe clarify that. It's interesting what you're saying. Oh, your work is better, FYI. Okay, tell me what you're saying, Bill. I'm curious. Okay, so if the market's not trending, it's in a corrective phase. And the good news is there's only 3 kinds of corrective patterns in the Elliott Wave world. There's a zigzag, a triangle, and a flat. Now, these can combine and go into what they call a combination, but there's only 3 Elliott patterns in the corrective phase. So the market's either trending or correcting. The market trends less than it corrects. So more times than not, you're inside of these corrections. So you've got to determine, you've got to get context. Are we in a directional market where there's a breakout happening, or are you in a correctional market where you're not going anywhere? So if you're trading future stocks or Forex, you're forced to constantly search for the directional markets and stay away from the correctional markets. Okay. Now, I was a spot trader. I started my career trading equities and futures and Forex, and that was obviously a directional trading pursuit. When I overlaid options on top of it, a whole new world opened up in the times that we weren't directionally trading. We weren't in an Elliott direction. When you are in a correctional market, which obviously it's just correction, but I'm just playing on directional and correctional, there's a whole new world that opens up where you can sell options when you are locked inside of a range. And Elliott, from my perspective, there's no better methodology out there to give you context as to when and where the correction should unfold and when you should not be trading directionally, but delta neutral, which is sideways via different option strategies. So it's true, a majority of your profits will be made in the directional markets, but when you can supplement your income by selling option premium in corrective markets, that's when you become a much more effective trader. So just some kind of reviews here for many of you. If you're new to options, you probably won't pick this up. This is going to take a little bit of study, but you can put on your bullish bias with directional option trading by long call spread, short put or short put spread. I'm not going to go through that. You either know it or you don't. If you don't, let's just take some time later on to study it. It's not important to the presentation. If you want to be short, you want to be long puts, long put spread, short calls or short call spread. Okay, but if you are new to options, and let's just get a hand here, who is in there trading some options? And tell me if you're doing spreads, if you're just buying options, if you're selling options. Just give me a quick read so I know who's doing what. And I'll let those answers unfold. Okay, so buying options. Let's just take a look at Goldman here. All right, let's say we're going to buy 100 shares at $208.52. So you're putting $20,852 out there. Your upside is unlimited. That's your max loss. Okay. If you want to buy a call, okay, let's say you want to buy the 207.5 call right here. It's trading for about $3.70. So let's say you get filled at $3.75, so it's going to be $3,750 in capital that you are going to put out there as opposed to the $20,000. Sounds pretty good. You still have unlimited upside gain, which sounds great. Keep in mind, stock's at $208.52. Now let's jump in the time machine and let's go out. What did I do this? Go out to some date in the future. Go out to June 19th. Okay. Let's say the stock goes from $208 to $209.5, call it. Gain about $100 or about 0.5% on the investment. So, okay, the stock moved up $1. What happens if we go out and Goldman moves up $1, but you're holding the options? So there's something on Thinkorswim where you can go out and do the theoretical price. So the stock goes up $1. You bought the calls for $3.75, but now they're at $2.08. So you paid $3,750, and now they're only worth $2,000, but the stock went up $1. That sucks. So you lost $1,600 in capital. So you have to overcome the premium paid, right? The stock's at $207. You paid $3.75 to get in. You're not going to make money until you get above $211. So you got to make a pretty big move before you start seeing any profit. You've got to get above $211. So that's a very big hurdle to overcome. And that's why so many people buy options, lose money, because you've got to see a pretty substantial move to make any return. So what you give up and not allocating so much capital to the trade, you pick that up as an advantage, but what you give away is a required move to be right, not only in direction, but also in a timely manner to make any money buying options. So how do you benefit from the amazing leverage options afford, but lower the high thresholds required to attain profitability? Option spreads. And anybody who's new to options, here's what you should be doing. And it makes me really sad when I hear people say, well, I got into options trading, I bought some options, but I'm scared to do option spreads. The scariest thing you can do of all is buy options. The safest thing you can do when you're getting started with options is to do option spreads. So the way I approach trading within the world of Elliott is I like to have context. I like to have a plan. I like to think the market is going to go from point A to point B. I'm not trying to big game hunt. I'm not trying to buy options at 50 cents and sell them for $5. That's not a sustainable long-term trading game plan. You can get some huge gains, but you're going to have more consistent losses. Okay, we're trying to get consistency. Option spreads are a wonderful way to do this. So this is, for me, when I finally, spent half of my career, I was like, okay, I finally got the technicals down. I know the vehicle I need to be trading, and that's when enlightenment hit me, okay, after 10 years of searching. Using the tools of Elliott, okay, I have an idea where we're starting the trades, where we're stopping the trades. You can offload some of the risk, lower the threshold of profitability by buying and selling options based on your price objectives. Okay, these are called spreads. Have it take profit and an objective. That's a key part of your trading plan. So the vertical debit spread, which I'm sure many of you know. If you don't know this, you won't. You're going to have to go back and study it. But I'm going to go a little fast just to keep you guys going. But this is a great way to trade directionally, but also offload the risk. Long one option and short another one. Risk is 100% capped, but so is reward. This is the most popular and easiest way to begin trading options. If you're just long an option, you're like this polar bear and the ice is melting below your feet. And what's ironic about this picture is it doesn't matter because polar bears like the cold water and can swim anyways, but you get the point. If you're long an option, the ice is literally melting below your feet. But if you buy an option and sell an option, you're minimizing that melt. Okay, so simple way to do it. Let me just skip to the picture. Let's say you think the stock is going from 102 to 104. Buy the 102, sell the 104. You have an objective. Okay, that's called trading with a plan. Now, how do you know where you want to sell the option? Well, you got to have an objective. And of course, that's going to be given to you by Elliott and Fib. So through the different kinds of work that you'll do when you spend some time and begin to embrace this methodology, I know, okay, here's a wave 4 triangle in Tesla. I've got a bunch of Fib up here to say we need to be going around 320 to 330, 320 to 330 bucks. We're trading 305 right now. So here's where I want to get in. Here's where I want to get out. And you can learn all of this from the rules of Elliott. All these calculations are basically Fib from all the different waves in here to give you your objective. So you're trying to go from point A to point B. So how do you structure this trade, right? How do you structure this trade? You can buy a call, and let's say you buy the at-the-money call. You're buying the 305 call, okay? Tesla's trading at 305.60. You're going to pay about $14, $14.40. So that's going to be $1,460 in premium. But check the break even. Okay, you're trying to go from 305 to about 320. You buy the at-the-money call, and your break even, you don't make money until you get above 319. Well, that's no good. because I'm just trying to get up to that point right there. So buying the at-the-money call, you're doomed before the trade even begins, because by the time you get your objective, you finally starting to make anything on the trade. So buying the call is not going to work. What if we bought the 305 call and sold the 325? Now all of a sudden, okay, you're putting down $760, and your break even has been lowered to 312. The break even before just buying the call was 319. Now we get it to 312. That's a little better. Okay, that'll work. So just comparing the two, right? You're not going to make money buying the call until 319. You'll make money on the call spread at 312. This one, you have a max loss just buying the call at $1,460. This is roughly half. You're only putting out $760. You're making money earlier. You're putting out half the capital. But what you give up is unlimited risk, unlimited profit on the top side if Tesla explodes. But we're not playing that game. We're not looking for home runs. We're trying to hit singles and doubles. So this presentation is geared for people who know Elliott. So I'm gonna kind of move through this a little fast. But basically what I'm saying here is, in the world of Elliott, once you study this a little bit, when you see one of these sideways triangles, 9 times out of 10, that's a wave 4 in a trend. Okay, that's the 4th wave, which means there's one more move. Okay, when you see a sideways triangle in a trend, usually wave 4, there's one more push to go, and then we reverse. So better yet, rather than doing the 305, 325 call spread, why not do a 1x2? You could buy one of the 305s, sell 2 of the 325s. Now your break even is at $305. Remember, it was 319 to start with the call. Then it went to 312 with the call spread, and now we're down to 305 with a ratio spread. Okay, max profit is $1,920. Now you are naked short a call, so the losses can pile up if this thing really gets away from you. But again, if we get too much above this area, we're going to get out of the trade and we're going to contain the risk. So a couple different ways to trade the objective. You can buy the call, do the call debit spread, do the call ratio spread. This trade costs $1,400, $760, $82. Risk 14, risk 700, unlimited risk, but losses occur above $330. We have a long ways to go. Profits, 1240, 1920. Here's your break evens as they get lower. So there's a couple different ways, and when you start having an objective to get in and get out, you can start lowering your costs, increasing your profits, and trading more with a plan. Okay. Now, guys, trust me, this presentation is geared, this is a little bit more heavy than I do, on normal. I'm just talking to a new group of people. Trust me, I'm hitting you with the hard stuff right now. So don't get discouraged if you're not following. If you're interested but confused, it's not intentional, but you're exactly where you need to be, okay? And I see so many cool questions coming through. Please, I'd love to sit here and engage and interact with you guys. It's always tough in these multi-speaker events to stay on time. I mean, I obviously love to talk, so just understand that. And Gerald makes a good point, Todd. If you consider delta and gamma when you buy a call for every dollar it goes up, absolutely. But that actually really doesn't come into play. I mean, if you want to buy deep in the money calls, that is certainly one way to do it. If you want to buy like delta 70 calls or delta 80 calls and have it act like stock, that's absolutely fine. And you'll be subject to less decay. But you're still going to have a pretty substantial cash outlay. Sam, we're going to be talking about volatility coming up here in a second. Good question there. Okay. So, really good here. If you get a first move up off a low, okay, so Amazon gets crushed, you get a first push, sell off in wave 2. All right. I always like to structure my trades. When I have a move up, a pullback, a corrective move, I always like to get to the 100% projection. So what that means is price distance traveled here. Let's say it's $60. I like to find the $60 rally. And this is a really nice way, just a simple trend that I'll trend trade pullback that I'll teach you. The 100% projection, you can do this in any software, Thinkorswim or Motive Wave or whatever you want. Okay, so you can buy a call spread. You can buy an at-the-money call right around the 900, and the first thing I like to do is then sell the one that corresponds to the 100% projection. So if this was a $60 move, look for the $60 move. This is the first step to trying to grab a wave 3. All right, so you can do a 900, 970 call spread. If that's a little aggressive, you don't want to do a $70 wide call spread, you can nuzzle up a tighter call spread just below the 100%. So do like a 940, 950 or 960, 970 or something like that. Okay. Or if you think we are going to break higher and get up to the more traditional 161%, so in a good Elliott wave, you get 1, you get pulled back in 2. Wave 3 usually winds up being the longest wave. And a textbook objective is the 161% of wave 1. If you really want to press the bet, you can do some call spreads up in here, drastically improving your reward to risk ratio. Okay, so this one has a max profit doing the 900, 970, 4,900 bucks at 2,000 of loss. This one has max profit of $5,300 with a max loss of 660 bucks. Much better reward to risk ratio here, but probability of success is less. And in my opinion, the only way you can put yourself in these positions to make 5,300 bucks risking 660 is to have context to say, I think we're in a third wave and we should be able to move up towards this 1,000 mark in Amazon. So selling options, okay? So these are debit spreads. Now, you can also sell spreads. How do you know when to sell options via credit spreads or buy options via debit spreads? How do you know whether to buy a call, sell a call, which is a call debit spread, or if you want to be bullish, you can sell a put, buy a put. That's a put credit spread. Options trading is kind of a rigged game, okay? Market makers like to price things where they know it's going to stuff their pockets the most, benefit them the most. So you can kind of have an idea of the options that are likely to expire worthless, okay? So when we're selling options, we like to do it obviously in options that we think are going to expire worthless, all right? We prefer to sell call spreads where there's Fib and Elliott Wave resistance above us, and we prefer to sell put spreads when there's Fib and Elliott Wave support below us. So if you think there's expensive options that are expire worthless and you want to get long, sell a put spread, meaning sell a put here, buy a put lower. If the market's in a downtrend, you have a correction going on, and you have an idea that these calls are going to expire worthless, you can sell a call here and buy a higher call to do a call credit spread. So whether to buy options or sell options all depends on where implied volatility is. So let's just take a step back here, and let me just test your implied volatility knowledge. This highlighted area in the S&P, is this volatile or is this not volatile? Is that a high volatility period or a low volatility period? Well, if you look at the implied volatility, this is low, exactly. When the market begins to rally, ranges contract, complacency sets in, the implied volatility drops. And just as a heads up, implied volatility is basically just range. ATR, you can see average to range, how it overlays so well on top of implied volatility. Then once the market actually loses its uptrend, starts going in a volatile period like this, you start to see the ranges expand. And when volatility expands and ranges expand, high to low, when I say range, high to low on the bar, option prices get more expensive. So implied volatility fluctuates quite rapidly as a percent basis. Okay, the higher the implied volatility, the greater their perceived future movement will be. So the greater the perceived future movement, the higher option prices become, both puts and calls. Implied volatility is mean reverting. I'll show you what that means in a sec. I'm going to skip this and I'll just do it on the next chart. So, this is the classic thing. If you're right on the direction of a stock, you buy a stock at, you bought 65 calls with the stock at 60, stock goes up to 70, you're right in the direction, but the implied volatility dropped, you're probably going to lose money on that long call trade, okay? If you're right directionally, but you lost money, it's because implied volatility dropped. And the implied volatility is this purple line here on the Thinkorswim charts, and you can see it goes sideways, okay? It goes up, it goes down, it doesn't trend, it's mean reverting. Implied volatility tends to ramp up into earnings, which are here, here, and here, and it drops off post-earnings. So there's a couple of different ways you can look at and gauge whether implied volatility is expensive or cheap. The boys at Thinkorswim put out this nice IV script, which just tells you on a scale from 0 to 100 how expensive implied volatility is, or you can just eyeball it. Just, you know, throw a line that bisects overbought and oversold. If you're in the top half of the range, you're going to be above 50%, and volatility is deemed to be expensive or it's deemed to be cheap. So here's the S&P with the implied volatility, which is just simply the VIX. Okay, so at the money, puts and calls in the S&P. Okay, so if implied volatility is high, you want to lean towards credit spreads. All right, short one option near to the market and long another, and the same underlying, the same expiration, but further from the market. And I'll show you what that means. Risk is 100% capped, but so is reward. Probability of success is often very high, but the risk-reward ratio is often skewed against you. I'm going to skip that, and I'm just going to show you what it looks like. So if we think the market's going to move down, we have an idea that these options are going to expire worthless, you can sell the 102 call, which creates a bearish bias position, then buy the 103. Okay, so you just want the market to continue lower. So here's target. Okay, right here, target, when I captured this chart, was in the 91st percentile in terms of implied volatility. The actual implied volatility is about 31%, but if you look at the 52-week scale, it's in the top 90th percentile in terms of being very volatile. So options are very expensive. So again, with this voodoo work that I can teach you to do, it makes a lot more sense to sell calls into the resistance level. Okay, sell calls up into Fib and Elliott resistance because you have context. You know that we're in a fourth wave correction. You know how to do all the Fib analysis to say, here's your big zone of resistance. And you can do this on any chart. You don't need any special charting software. So that's the way you kind of approach the markets. Credit spreads, both call spreads and put spreads, can be combined in strategies to profit from longer range-bound markets. Okay. Let me just show you a couple live ones I have right now. I have a put spread going on in Apple, and I just saw Apple just faded the hell out of the gap up. We're down 1%. Earnings are tomorrow. Let me just kind of give you the context of where I think we are in Apple. Okay. I think we're in a wave 5 rally in Apple, and that wave 5 move began way back here in May. And I think that's wave 1, wave 2. Here's your widespread participation in wave 3. We just did a big old sideways consolidation pattern. I think that's wave 4, which is a triangle. And then I think we're in the distribution phase. So we have a little bit more room to go here. I think Apple can get up to 180 to 190. We are heading into earnings. So let me get off the daily, go down to even down to the 15-minute chart. So here's that long triangle that we just broke from. And guys, I did this yesterday. I told my clients, guys, there's going to be resistance in Apple following this wave 5 move into 171. As I said, I'm long and I'm losing money today because I was right, but I'm going to hold it through earnings. So here's Apple live position. I was up pretty good money today, but I'm down a little bit of cash here. I've got the 150, 145 put spread with 16 days to go. I have it in this account and I have it in this account. Okay. So I've got 150, 145 put spread. I'm going to hang on. Okay. I'm not, because I'm short 150 puts, long 145. It's a put spread. And the reason is Apple implied volatility is really jacked up. It's in the 100th percentile right now because we're heading into earnings. Over the last 52 weeks, there is no other time where Apple implied volatility is really expensive. I'm also in a Facebook trade heading into earnings tonight. Facebook implied volatility is in the 91st percentile. If we go over to FB, I've got a call butterfly going on right now. I'm thinking we should be able to move up to the 100% projection. So wave 1, take that distance. Equality or the measured move or two-step pattern or AB equals CD is going to be at 184. If this is a true wave 3, we should be able to get up to the green level, which is around 193. So for the way I'm positioned is I've got the 180, 185, 190 call butterfly. Okay, so I'm taking this into earnings. So I'm hoping when you move up to that 185 strike into earnings. I'm probably going to adjust this into the close because it is acting strong. It's up $1.70 today. So I'm going to try to adjust it a little higher, maybe go up to the 187.5 for that call fly into earnings. But it's all based on Elliott as well as the expected move. Okay. What does that mean, harmonic move, Marcelo? Okay, so I'm going to kind of skip this a little bit. This is just a live trade I did. And we have a pretty good resistance. Just in GMCR. Sorry, this is GDX. Just showing the objective of, of trying to buy into support, Elliott and Fib support around 29.5, trying to get up to 32, send the trade out. It works out. And then this was fun. I just recorded this live. I have a second job at the distillery. I'll tell you about that. But I did a just an iron condor with positive delta just to try to get the move up, and made $1,000 on this trade. Just quiet GDX, little wave 4 to 5 trade, and just closing it out. Another one, just kind of showing you how this works. They don't all work this well. This is just a really fun example. This is one of my favorite trades of all time. This is Green Mountain Coffee, GMCR. Stock had been getting killed. It was down into a wave 5 low, into Fib support. We put a pretty aggressive trade on, which is called a bear call ladder. And basically, it gapped up on bad earnings from Fib support, had the trade on, and so we sold a 52.5, 55 call spread and then bought the 57.5 call. So the 57.5 call was uncovered. Bought it at 85 cents, and it went to $32 because the stock gapped up. It got bought out. So the money from that coffee trade, I actually invested. This is my second business in a craft distilling business, so coffee profits into whiskey. So anyways, guys, so it's about anticipating, and I know I just gave you a quick run through on Elliott, and there's a lot there. Trust me, it's not something you'll pick up in a weekend. But it's something you need to work on for, I would say, 2-3 months. Practice it, and it's a skill set that you will acquire, and it winds up being about anticipation, giving context, and starting to anticipate trades rather than reacting. Losers react, leaders anticipate, says Tony Robbins. Okay, I see what you mean. I've heard harmonic moves is the same as a measured move. Yeah, 100%. Yeah, yep, no, you're right there. 100% is rooted very much in Elliott. So A equals C and an ABC correction, or wave 1 equals wave 3. So yeah, there's a lot of overlap there. So hey guys, if you're interested, obviously you can tell I'm pretty passionate about this. I really, really enjoy working with other people who like to kind of look at my way of trading. This isn't for everybody. But I'm a firm believer if you use Fib and Elliott the correct way, you can find better entries and exits. The only problem is most people overcomplicate it. So I have a course. If you're interested, it's packaged. It's ready to go. It's one of the best courses I've done based on feedback at this price point. Okay. So this course is called Optimizing Your Options Trading Using Fib and Elliott. I'm going to share with you my most powerful Elliott and Fib strategies to overlay on top of my best option strategies, to show you how the different option strategies overlay with Elliott. Stop guessing and risking valuable capital on substandard setups. So this is for people who want to anticipate quality trades, do the work before a trade, $1 goes into a trade. I think the best time to use that front part of your brain to not trade like a caveman is when the markets are quiet, when the markets are closed. Do your Elliott Wave work. Set up the trades. Don't be trading when the markets are moving or really volatile, because that's when you're going to be driven by emotions and make bad decisions. You need to be doing your work outside of the hours, have your trade set up, and then I don't trade that much during the day. Most of my trading and analysis is done off market hours. Okay. This is not the Holy Grail. I am not promising you the keys to the kingdom. This is an edge over the market, and most importantly, protecting you from your caveman tendencies. And I have them too, don't worry. So it's not going to have you on the yacht with the Wolf of Wall Street, but it will give you an edge. So it is optimizing your option trading using Fib and Elliott. Tackle the key price patterns as identified by Elliott, suited to option trading. Master the 4 tools of Fib price. Build Fib support and resistance zones to isolate the entries with the most profit potential. Fib time is key for you option traders who want to pick the right strike, or pick the right expiration, I should say. Art of the trade is important. Account risk and trade management. As I mentioned, I used to trade for a hedge fund, and I learned some pretty valuable stuff in terms of handling your capital as a professional, how to structure your tiers, how to set up your conviction in different tierings, and then really how to control your capital as a pro. Some people say this is worth the whole price of the course. Download the option strategy position calculator, position size as a pro. You also get the option strategy selection guide. These are all downloadables. That's in the course. It's pretty well packed. So if you want, guys, you can jump in here. It's tradinganalysis.com/oh yeah. So I'll type that in a minute. Here's what you get. You get the 2016 version. You get the 2017 version. You get the Art of the Trade option strategy position calculator. You get the option strategy selection download. Live trading was done. This is a course that's happened in the past. We're giving you a significant discount on this course. So this is all recorded and occurred in the past. So we traded live on May 24th. I traded live on May 31st. Easily worth over $1,000. You guys can get done for $161.80. Okay, so tradinganalysis.com/oh yeah. Now let me just drop that link in there for you. Oh, I can't do it. I'll give it to you in 1 second. I got to pull up the GoToWebinar room. We're going to close this out Friday at midnight. Okay, so there's only 50 spots. So it's tradinganalysis.com/oh yeah. This has been a really, really good course. It's available online. It's all complete. I'll even show you the course here in a second. It works, Elliott and Fib works on all markets, really, really works well with Bitcoin. I'm trading a ton of Bitcoin in here. In fact, I'm long, and I'll show you I meant to show you this earlier. I have upside objectives. I'm long Bitcoin. I think we're going to move up to about 8,000 in wave 5 of 3 into this Fib end channel. So this is kind of what I'm showing here. So if any of you guys are looking to get into Bitcoin, I've been trading it for 3 years, Bitcoin with Elliott for 3 years, and I've literally tripled my trading account. Elliott works wonderfully there. So it works in all markets, but this course is a little bit more focused on options, and it's great. This class, the feedback was amazing. So I did a survey in the class, and here's the feedback. How would you rate the quality of optimizing your options with Elliott and Fib? Very high and high, no low marks. How likely would you recommend? From a scale of -100, which means I hate you, to 100, which means I love you. I got 81. How would you rate the value for money for this course? Excellent, above average, and no low scores. How likely to purchase again? Likely, extremely likely, very likely, somewhat likely, no low scores. This is just feedback. I've been using these techniques on and off years. Todd provides clarity, started trading, but I think he meant to say combining with Elliott is dynamite. The course provided me confidence, knowledge to trade using Fib and Elliott more than I've ever had. Changing my life. I don't know about that, but that's a quote. Awesome course. Helped me understand Elliott and Fib. Todd's trade ideas helped me make enough money to pay for the course. Now, I can tell you that was absolutely the case. We traded live in the course, and if you traded one lot, people doubled their return from what they were actually trading. It doesn't, what they invested in the course. It doesn't always happen that way, but if you traded one option contract, the original people doubled, and you're getting this a substantial discount. I can actually show you the course. The training courses right here on Trading Analysis website. It is optimizing your options right here, and this is what the course looks like. Option strategy selection tool, live trading, recap, Here's the survey that I just showed you. Content, downloads, content, download, more content, more content, more downloads. I could charge $1,000 for this course, guys, no problem. Okay, so if you're at all interested, I really think you should buy it. If you are interested but somewhat confused, that's perfect. That's exactly where you need to be. Fib price, you got it, Bob, 1618. All right, let me just see here. Go to webinar, always kind of maximize. There we go. Okay. Trading analysis, analysis.com/oh yeah. And that should bring you right to the checkout page for 1618. And we'll do this for 50 spots. I have a feeling it's going to fill up with the amount of people that's in this room. And the, okay. So there we go. Questions, how am I doing for times? 11:30, 10:45. Oh, I'm pretty early. Course is available forever, Win. You have it forever. Yep. So you'll have what will happen is you have a username and password. So you go to my site, which is tradinganalysis.com, and go to the home page. No, William, if you're new in options, we start right at the beginning. There is a ton of content in here. So if you're new, I mean, you can even treat it as a new options intro. Okay. In fact, here's options intro, 2 hours here. And here's part 2 to options intro, an hour here. So I got 3 hours of options intro there. Elliott, Fib, intro to options again, option plays part 2. So don't be afraid if you're new to options. And live trading, as I said, live capital, executing the trades, giving you the reasoning, getting into the trades, getting out of the trades. Like we trade really, it doesn't always happen that way, but we trade really well in this course. So. But anyways, what that means is you'll get, if you purchase, you'll get a username and password that'll last forever. You go to members area, and then you go into training courses, and you'll have access to optimizing your options with Elliott and Fib right here. That's the course right there. Okay, so easily, guys, we can charge you $500 or $600 for this course, but you know, we're not going to do that. So. Good deal, 1618. If you're at all interested, I definitely recommend. The feedback was just awesome. So what kind of questions? Other questions? There you go, Virginia is well worth it. Yeah, Virginia is a student. And we can even take a look, because I know we have some time. If you guys want me to take a look at some markets, I'll show you what's going on. Let's see. Throw some markets in there that you want me to take a look at. Okay. Tesla. Okay, Tesla is interesting. I think Tesla is in a triangle, and I had this conversation with my members yesterday. So I think we're in a longer-term fourth wave. Okay, so here's Tesla from the lows. I think we go 1, I think we go 2, and I'll show you how to do this in the course. 3, and then I think we're doing triangle 4. I don't know where the market's going to go. I think I have EQ. I can kind of control my caveman tendencies and say, if this is in fact a triangle, we have A, we have B, we have C, and I'm looking for a D wave rally. If my analysis is correct, we should not break below 303.13. This is wave count and validation. Okay, this is where I'm completely wrong in the trade, and I need to get out, contain the risk. There's a whole cluster of fib support, which is calculated from the different swings. There's a 618 level here, 1272 here, 1618 here, and 100% here. Who was asking me about harmonic 100%? Marcelo. A equals C at 308.40. You do the 1272, so you take an extension of this swing down right there. Whole cluster of support between 328 and 308. I think it's going to hold, and we should be able to move up to 360. I'm looking for $40 of upside, and the risk is $19. We're at 322. I'm wrong at 303. I don't know what's going to happen in the future, but I'm completely fine with that because I know I followed the rules and the guidelines. We should have support in this zone. We should be able to move up to around 360. It's going to cost me $19 to see if we can make about $40 on the top side. And I'm completely fine with that. I'm going to put the trade on, and I'm not going to stress because I've done the work. Okay? I'm weak on Elliott. How much Elliott education is in there? Did you see how many videos were in there? Like, there's tons. There's tons in there. So, yes. Hey, Win. Oh, there you are again. I've taken several of Todd's courses. They're always a great value and very educational. Thank you very much. Yes, definitely. If you need some Elliott exposure, that is a wonderful place to go. SPY, yes. S&P is funky in here. I have a bunch of resistance in the S&P from 2537 to 2700. I think there's going to be a pretty significant top right in here in the market. Okay, it's been really choppy here over the last couple months. We're starting to get a melt up here in the NASDAQ, but the S&P has four level fib resistance zone into 2700. So I think the next 100 to 120 points in the S&P is going to start producing some serious volatility. And look at what it's doing today, man. It gapped open and it's closing the gap. This market is getting. And you know what? That might have been it. That might be it. I'll tell you why, because this is the 60-minute chart. So I'm looking at 1, 2, and I'll show you how to do this, but your wave 3 has got to have 5 smaller waves. So 1, 2, there's your continuation gap, which is common in wave 3. Then we're doing a pretty funky triangle pattern. And then I'm looking for a final wave 5 move. And wave 5, wave 3, and wave 1 needs to be 5 smaller waves. And we have it now. We do have 5 waves inside of 5 to complete 5 to complete a larger degree 3. And again, I don't know what's going to happen, but you could be short, stops just above the high, looking for a retest of wave 4. This is a pretty interesting gap up, and we're starting to close the gap into a wave 5 move. And I'm just doing some fib analysis here. Interesting. NASDAQ's also no wave 5 move. 1, 2, 3, 4. Wave 4 did not move into the territory of wave 2, and we have a ton of resistance up here. We're getting close, guys. Okay, what else you got? What time am I off? So I think it was on 10:45, I think it was. Yeah, okay, I think we're all right. Anytime you guys want me to move on, I'll keep going until you kick me off stage here. NVIDIA. I have a little bit less confidence in NVIDIA. I'm thinking, the process we go through is like, all right, find the beginning of the uptrend. So the uptrend starts here. Find the biggest correction. Well, there's a big correction here for wave 2. This is going to be all 3. And I'm looking for something that is of similar depth and duration to call that a 4th wave. The other part is if you do a fib projection of wave 1 compared to here, 100% is 227. We haven't even gotten there. Usually wave 3 is longer. Usually it goes up to the 1618 up here. So I still think there's room to get up to 227 in NVIDIA. NVIDIA's held in there really well. It's a great proxy for Bitcoin. Bitcoin's acting very well. I still think there's room up to 227. I still think there's room up to 227. I'm just doing some Elliott wave counts in my head. Yeah. What else you got? What else you got? Rosa, good question. Do you use Elliott to day trade E-mini? I do when volatility really picks up. If vol is super low and ranges are terrible, don't day trade anything, like nothing, okay? Waste of time, waste of commissions. When volatility really picks up and you start getting 20, 30, 40 handle ranges in the S&P, then you can day trade it, yes. But if vol is low and ranges are pathetic like they are, don't do it. Yeah, Alibaba is a tough one for me. I have a better feel on Baidu, if that's okay. I was doing the work on Baba yesterday. I didn't like it. Baidu, for me, I think, is a major premium selling opportunity. I think Baidu is doing 1, 2, 3. I think we're going into a wave 4 sideways consolidation between like 280 and 230 for the next 2 months. So I'm going to be looking to do some like iron condors or butterflies inside of this fourth wave, which could be something like a triangle or a complex correction or something. I'm thinking we go sideways in Baidu, right around the 250 mark. 30-year bonds. Okay, bonds are interesting. I was talking to clients this morning about this. Bonds, I hate to say I called it, but I did. Last 2 days, I was like, guys, I want to be bearish bonds, the 30-year, but we're doing this expanding diagonal, which is a reversal pattern. Everyone's trying to get short bonds. We're into the 618 retracement of the move up. There's a bunch of fib right here. I was like, guys, we can't be short. I almost got long a couple days ago, and I would have been right. I didn't. But we're getting the reaction that I expected. So I think bonds are going to start to rally. And we do have the Fed coming up here, obviously, to see what's going on. But I think we should at least be able to go up and test the 618 retracement of this drop, which is going to be 155.06, 630 seconds. BA just did a wave 5 top Boeing, and I think this is shortable. Massive drop after a good 5-wave move. Post-triangle thrust means wave 5 is it. 5-wave move inside of green 5, we drop. I think Boeing is shortable. Amazon, haven't looked at him in a couple days. Amazon, we're going to need a 5-wave move, so still buyable. Wave 5, wave 3, and wave 1 need to have 5 smaller waves, so we're waiting for the wave 4 pullback. Similar depth and duration to wave 2. So something like pin and pin. Oh, that's perfect. 1080 and 1057 are your supports in Amazon. I don't have currency quotes in here, Sam, unfortunately. I used to, but they don't move anymore, so I don't really trade them. I don't know. And let me see. Cat. Am I following anything in Caterpillar? No, I'm not, unfortunately. No wave count worked up. Oh, I used to. Okay. Not for a while. And, you know, sometimes it's just as simple as this. All you need is one of the corrections, okay? So Caterpillar is trying to work an ABC zigzag. So you don't even need to know what the higher time frames you're doing. Just if you want to try an ABC zigzag, look for the equality of A and C. That's going to be at 132.34. We are testing a 618 at 34.65. I would feel better. I'd feel better to get CAT down around 134 to 132. I wouldn't chase this move up yet. I would try to get the stop run. This is a classic zigzag signature. So you go down in A, up in B, try to suck people in on the long side, stop people out below the A wave low, and then grab the longs down into the fib support right there. So this is, you know, it's about having context, as I mentioned, like waiting for the market to come to you and demanding a good entry. Okay. So guys, that's going to be it. Tradinganalysis.com/oh yeah. So you get the old 2016 version. You get the new version. You get the art of the trade, option strategy selection calculator, let me say it again, trade option strategy position calculator. You get the option strategy selection download, live trading, 2 live trading sessions, real capital, easily over $1,000, but you can do it for 161.8. Tradinganalysis.com/oh yeah, and we will close that out Friday. And hopefully that was okay. A little too much information. I'm going to need to brush that one up ahead of Vegas, I think. But the course is solid. The presentation skills are not the best, but that's okay in terms of a marketing webinar. But I love trading live and doing this stuff and teaching this stuff live. So I'm sure you're going to enjoy it. All right, guys, we'll leave it there. Thanks so much for having me on the presentation, guys. You got a lot of good content ahead of you. Enjoy it and take something from everybody, build it into your own trading plan, and once you've got it, stick with it, okay? Oops, come on back. Oh, let me show you one more thing. I want to show you something crazy in the Dow. Okay, come on. All right. We are coming up in a longer-term Dow resistance. The Dow has been super, super strong, but here's where I think we are. Here's the context for the Dow. The rally, I think we're coming up in the end of wave 3. Wave 3 needs to have 5 smaller waves. And the quickest way to do it is find the 2 biggest corrections. Okay, so there's a big correction here, and there's a big correction here. So those are going to be waves 2 and 4. Okay, so there's your 5-wave move. 5 waves is going to make up a higher degree third than the prior green 2, which is of the same family, is going to give you your downside target. So I think we're going to have a wave 4 that's going to be kind of anchored off this correction here. So I can just quickly hotkey this with this software, but you can do this by hand with Thinkorswim. It just takes a little bit more time, but this is a little faster. So if the Dow, when the Dow finally comes off, I mean, you're talking another, probably a 3,000 point drop in the Dow just in wave 4. And if people, when we finally get it, people are going to be like, oh my God, this is the top. It's going to crash. Everyone's going to freak out. Volatility is going to explode. But again, you have context. You're like, okay, yeah, I mean, we got a couple thousand points to fall in the Dow. It's no big deal. It's a wave 4. Wave 2 is going to give me the context. And I can tell you, it's probably going to be long and drawn out and sideways. There's a guideline in Elliott Wave, which is called alternation. If this is kind of a simple ABC correction wave 2, I'm going to expect wave 4 to be super choppy, super volatile, all over the place. It's going to drive a lot of people mad if you don't have the context. Okay, so something like ABC, up an X, and then another ABC. It could be a triangle. We don't know. It hasn't even happened yet, but it's going to be a lot of back and forth action in there. And again, you'll know, okay, it's a higher degree fourth. We should move into, the lower part of Q1, Q2 of next year. I don't think it's going to break below Dow 20,000, but when it does happen, it's going to seem like the world's coming to an end. But when you have that context, you're like, all right, it's not such a big deal. Hey, Garrison. Marcel, looks like resistance equals future support. Kind of matches the fib zones. Kind of. Resistance equals future support. Yeah, I mean, there's that old, when resistance is broken, it flips to act as support, yeah. Let me show you something really cool. You want to see how quiet this market is? Let me find another presentation. This will take me 1 minute, but I think you guys will like this. Desktop. I just did another presentation. Check this out. So I just did a presentation, the 30-year storm is coming, and I showed you that we are in a really, really low volatility period. So here's the Dow on the monthly going back to 1905. And this is the average percent true range. So this is the ATR, it's a high to low range over the last 21 months, but not presented in terms of Dow points, but in terms of percent change. So the average percent true range, this measures high to low on a percent basis over the last 21 months in the Dow. 1914 was 4.69% high to low on average for the last 21 months. There's the 29 crash. Really low volatility period here in March 54 at 4.59%, 4.64% 1965. Right now, we're at 4.52% in the Dow. This is the lowest volatility on record going back to 1905 in the Dow. That is not going to sustain. And when the ranges start moving up is when we will start to see the correction. There's something else that's interesting in here. Heading into the 1987 crash, the stock market continued to rally, but the APTR increased. So we started to get range expansion heading into the top. Same thing in 1929. You started to get range expansion heading into the top. And then the market goes. So people start to get aggressive and kind of jockey in and out of positions, and that blows out the ranges. We're not ready for a top yet because I think ranges are at the absolute low. So we've got to start seeing this move up a little bit as people start to move in and out and start to take profits and get in. And the battle's got to start before I think a top is going to unfold. And using the 29 crash and 87 crash as precedent, that'll tell you that we're not going to crash in such a low volatility period, not crash or sell off. I think we need to start seeing a pickup in vol before we can start looking for a sell off. So that's why I'm just going to respect the trend for now. All right. So guys, I'm going to leave it there. I hate to run out, but I appreciate the extra time. And guys, great job with putting this event together. I really appreciate it. And I hope you guys get a lot of great content. I hope to see you in the course. If my stuff doesn't work for you, I hope you jump on board some of the other 5 presenters and find somebody that works with your style. Stick with them, consume them, and learn everything you can. And don't jump around, okay? So guys, thanks a lot. Check it out, and hopefully I'll work with you guys soon. Thank you.